One of the things, there are some things about silver that I would like to discuss that most people don't talk too much about, but I think it is very, very important to highlight some of the catalysts, if you will, with silver right now. One of which is the reclassification by the US government recently, just reclassified silver as a critical mineral.
Mhm.
And because it is a critical mineral, to me, what that means is that there's a floor now underneath the price of silver. The U.S. government is openly accumulating it. Look at the amount of silver coming into COMEX, and this is well beyond the average speculator. You're talking billions and billions every single month. One of the interesting things about silver going on right now, we talk a lot about the short squeeze in London, where they have the lowest free float amount of silver that they've had in history since they started keeping records. They have less than a day's worth of trading, about 145 million ounces there. And with gold right now, we are seeing what's called open interest. Open interest increasing. That means more people are coming onto the COMEX. You're seeing more and more volume, and the price is going out. Price is breaking out of consolidation. This is the normal link between buying and higher prices. In other words, more people buy, the price goes up. With silver, it's different. The rally is being driven by speculators, but not by speculators, but by a synthetic short squeeze, in my opinion, because the open interest is going down, which means there aren't people buying. The hedge funds are moving away from buying silver right now, yet the price keeps going up. And that is because of the massive amount of deliveries and the little bit of product in the vaults that are able to deliver coming out of London since August. So we've seen 58 million ounces since late August, 10,550 tons year to date coming out of London. This is pointing to physical liquidity shrinking, mounting pressure on the market. So when you talk about the LBMA, data shows that they trade over 600 million ounces of silver per day, and between 1 and 2 billion ounces in paper claims, yet they only have 140 million ounces available to be delivered. What can possibly go wrong?
Yeah.
Yes, Eric.
Question again, forgive the ignorance, coach, but so the same way a stock price can be squeezed up, is that it's the exact same thing here?
Yes, see, these contracts that trade on COMEX, so in London, these contracts, they're trading 600 million ounces of physical silver contracts per day that have their delivery contracts. You can either cash settle, roll them forward, or take delivery. They only have 140 million ounces backing that 600 million ounce stockpile, or that 600 million ounce float.
Yeah,
that's not the
it's
float. The
leverage.
140 million is the float. The 600 million is the annual trading every day, or daily trading every single day. If those contracts, which now amount to almost 2 billion in paper claims, stand for delivery, there's only 140 million ounces there to fill the 2 billion ounces in contract obligations.
So are they forced to buy the actual metal,
Yes.
or they just keep rolling it into a future?
They are forced to buy it. So the LBMA, which is a T+1 settlement, T being trade plus one settlement, the third day the bar should be moving to your account. The Bank of England, most of this year, which runs the LBMA, which is the 140-year-old metal platform, the oldest in the world, said, it's 6 to 8 weeks because we have a shortage of manpower and trucks,
right,
instead of T+1. So imagine you own a multinational jewelry manufacturing facility. You make and fabricate jewelry, and you buy those contracts to give you the metal you need to make your jewelry. You're expecting it moving in 3 days. Eric, we're sorry, brother. It's going to be 6 to 8 weeks because we're short on trucks. And so this is exactly so. Most of my career contracts, whether it be in London or in New York, never stood for delivery. And that's what we're seeing. The sophisticated traders around the globe says, aha, we see what you're doing by rehypothecating, by creating more paper than there are bars. That's exactly what the Hunt brothers noticed. So very slowly they are standing for delivery. They are exploiting the delivery option, which is creating a massive problem. All of the metal that's come back to the United States, I believe, is to cover short positions by the U.S. banks, because they were clued in on all of this. And they said it was all about tariffs. It ain't about tariffs. It's way bigger than tariffs or arbitrage. They're reshoring and they're covering their shorts, leaving the European banks exposed naked in the wind. And if you get more and more delivery requests like this, as it is right now, same thing in platinum. In London, they're trading 3 million ounces a day in spot contracts that are deliverable. The head of the Japanese commodity market just came out and said there is zero platinum in Switzerland, there is zero platinum in London, yet they're trading 3 million ounces a day in deliverable contracts.
So, I mean, it's beyond interesting that you bring it up. And I guess my question would be, in your career, since it spanned 36 years, in the history of the COMEX in your career, I mean, now we're talking about for every 1 ounce of physical silver at COMEX, they're writing roughly about, what, 450 ounces?
Or more, yeah.
On paper. I would imagine that number has grown significantly over the course of time, over the last couple of decades. Did it used to be, 1 for 100, like an options contract? One options contract controls 100 shares of stock.
It was always rehypothecated. The difference is no one ever stood for delivery. Never. And maybe 1% or less. And I use the August contract as a good way to explain that. In the first 3 days of the August contract, we saw 2,160 gold contracts post, meaning they post. They're either going to cash settle, roll over, or stand for delivery. With it in mind that my whole career, literally 1% or less stood for delivery. Just that grouping right there, 100%. 2,160,000 ounces, almost 4 billion in gold, stood for delivery. 100% of them stood for delivery. Now that isn't the way that it always goes, but the point of it is that the cash settling of contracts is exposing the rehypothecation. It's, for the first time, it is actually challenging the solvency of the exchange. Now, what's really interesting is that the amount of metal that has come into the COMEX, it's as stuffed as I've ever seen it, but where it is completely and totally exposed is in London. And, there are rumors out there that President Trump is doing this on purpose. Now, the rumor, I can't substantiate it, is that he believes that it is the European aristocrats that were involved in the color revolution, that were involved in the here in the United States, and involved in election integrity questioning, all of these things, and he's trying to stick it to not only the Bank of England, but to the entire European Union as a result of it. And by the actions of it, when you have a half a dozen European banks that are as short as they are for physical metal deliverable contracts, it's an existential threat to some of the biggest banks in the world. And if the banks in the U.S. knew that, because typically what the banks in the U.S. will do, they'll short in New York and then take the commensurate place long in London. Right. So they're bringing back all the metal to cover their shorts. It's now stuffed into the COMEX, that which isn't leaving, because a lot's leaving the exchange. Yeah. Who's taking it, where the hell it's going is another question. But the rumor would be that the U.S. banks are trying to go long, whereas the European banks are still short. And if more and more delivery requests come, fireworks would begin, and it would send shockwaves.
I'm going to get to one more question, and then I want to have Eric kind of tell his story, so that we can.
Does that make sense, though?
Yeah, I mean, you generally don't, but yeah, that's it.
I mean, I know zero about this.
Would you like to take his place moving forward?
Well, no, listen. Does it make sense? Sure. As right. I started buying silver, so short the hell out of it. I'm in.
Yeah, well, the more they short it, the greater the opportunity is to get it, and yet the market keeps on creeping higher.
So my question to you about what you were talking about is, because of that, and you think it's the synthetic short covering, does that change your thought on where do you think silver is going to go in the time frame that it's going to go? I mean, right now we're sitting, I think as we were just getting on here, I saw us, even in the spot market, we're way over 43 now in the futures market, but I think the spot market was just at around 43. So, do you think that that's going to change the momentum of where silver is going right now?
Well, it's quietly moving higher. It's the frog in the pot of boiling water. No one notices that. It's every single day it seems to be moving up.
Well, this morning when I woke up, it was down 18 cents pre-market. Yep. And then today we ended up 40 cents.
Yep. That short covering right there. Yeah. 52 million ounces have already been delivered this month, with 3 weeks left to push the total even higher.
And don't you say that this isn't a big delivery month for silver?
No, it's not. Right. And, with silver up 43% for the year, massive deliveries coming in through COMEX. Yes, you want to say something?
No, I was going to just another question. The chart of silver, forget 1 year, 2 year, 5 year.
50-year looks outstanding.
It's
It is a full
Like
fledged
parabolic.
100%
It is
breakout.
a 45-year cup and handle.
Correct.
Right now, and we are right near the cusp of breaking out. The way that you figure that out is you take the tip of the cup, which would have been 50 in 2011, and the bottom, which would have been just under $4 in whenever that was, early on in my career. That difference is then what you would add on to the breakout, which would be about $46. So projected, if it breaks through 50.96 would be the next target. Here's another thing real quick about London. This is from Bloomberg. First time I've seen this in Bloomberg. Bloomberg confirms the London one-year implied silver lease rate has blasted above 5%. While on September 4th, the JBMA, the Japanese mark, that's who I was talking about, Bruce Ikemizu, reported a London one-month lease rate rocketing to an extraordinary 6.4%. Over the past 2 decades, silver lease rates, 1 month, 3 month, and 6 month, have usually hovered well under 1%. Even in tight physical markets, they often spike into the 1%, 1 to 3% range only briefly. Private investors are draining the LBMA vaults, driving lease rates to all-time highs and exposing the fatal shortfall in deliverable physical silver. Hold on. Bullion banks trapped by their own over-leveraged promissory notes are unable to deliver physical contracts, may unleash true price discovery and the revaluation of real assets. A 5% lease rate indicates severe tightness in available supply for lending. It's as high as 6.3, tied to physical shortages in London vaults or stress in the forward lease market. This is a big, big deal. And then you add the
that's
U.S.
why I wanted to say, I have a feeling that not everyone out there knows what you're referring to when you talk about lease rates.
Lease rates meaning if you have a short position and you need to cover and you need to get the metal like now, you're going to pay 6% to get it from one of these banks. They don't want to give it up. 6%, you're dead in the water.
So basically, it equates to the same thing as what a brokerage firm in stocks would charge you when you want to short a stock.
Yes.
They charge you a certain amount, and it depends on the volatility of that stock and the availability of that stock, whether or not it's going to, and those numbers could be astonishing.
So look at the big picture. Right. Huge deliveries, lease rates spiking, massive over leverage, and the United States now calling it a critical mineral, putting a floor underneath it. This means that big buyers are entering the market, including the U.S. government.
So, I mean, just out there, we're at 43 now. Do you think that, are we done in the 20s? Will we ever see the 20s again? In your opinion?
No, I mean, I think the 20s would be crazy because in all of the years that I've seen great suppression, they would step on it and it wouldn't come back. There's so much physical demand right now, it just shoots right back up. They haven't had the ability to push it back. And I think, look, given the inflationary and monetary dynamics, I think, look, if I were to say it could go into the $200 zone, if momentum takes over, people would say you're out of your mind. I don't think it's crazy.
No. I listen, you know me. I've been even more, I think, optimistic than you sometimes, especially coming on here. And you don't generally put your predictions on there where I have no problem in doing so. But I'm saying most people don't even realize that the $30 range with silver was never a highly frequented number for silver. It was back in 1980 with the Hunt brothers, and then back in 11.
Yep.
It was very, very short-lived. I think that the silver spent maybe 2 weeks, if that, in those $30 ranges before it came, crashing down. So this time around, we have built a base in the 30s for months and months and months.
And now they're lowering rates, which will only accelerate it.
I mean, look, I think the only time that I can recall in the very, near past that we've had, that when we fell back into the 20s was when the tariffs were announced. And it was literally, if you look on the chart, it's a blip. And it came down and almost instantly recovered back up.
But from a standpoint of performance, silver has outperformed everything, including Bitcoin this year. From a standpoint of performance, it's been over a year now, maybe 2, where if you measure Bitcoin in gold ounces, gold is outperforming Bitcoin over the last couple of years in measuring it in gold. And many of the things that are very expensive right now, like food, like housing, like tuition, measured in ounces of gold, are actually going down. And that is because it's the value of the dollar that we measure things against that is losing ground so precipitously against other things. So you're right, it should be. But, again, this is one of these deals where gold and silver have outperformed every traditional asset, with the exception of Bitcoin, since its beginning. But that trend has changed actually fairly significantly over the last year and a half to 2 years, with silver and gold outperforming Bitcoin.
Yeah, and we really haven't gone over too much the GSR, the gold silver ratio. I think over the weekend, forgetting what happened today, because both metals were up again today, I think the GSR stood roughly at around 87, 88. And even though, both metals, but predominantly silver, has made a great run just in the past few months, it's still dirt cheap compared to the GSR.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics, it's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation, silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.